Ladies and gentlemen, it's Adrian's Duntrick, CMT Charter Market Ignition. Welcome to the second session of the day of our free trading congress, or I should say Trading Congress 2024, the sixth edition of our virtual trade camp trade summit, optimized to help many traders become better in just a couple of days at no charge, at zero cost, basically, coming from the best speakers, from the best experts, from the best people that I know, that I've learned from, that I always look up to. And one of them is our today's guest. Aksel Kibar, CMT, has been to our sessions, has been to the previous edition, the editions of the Trading Congress, and it's going to be my incredible honor to welcome Aksel right now to the session. How are you feeling, Aksel? Welcome to the
Hi,
show.
Adrian. It's a pleasure to see you guys and to be part of this Congress. It's great here, and we have some content that will be exciting for the audience, I'm sure.
Oh yeah, that's correct. And Aksel Kibar, for everybody, you know, he's gone. You can find him basically on the Twitter on X under Tech Charts. And Aksel has always been one of my look up to persons. He's always been one of the guidance, this light at the end of a tunnel for me regarding the classical chart patterns from Edwards and Muggy, from the very classical charting principles and technicals, like no one else does this so well in the space. And Aksel has prepared an incredible presentation for us, for each and every single one of you who's watching and viewing that. So if you actually are watching and listening on YouTube, on Twitter, on anywhere else, make sure you leave a mark, make sure you leave the subscription button, definitely hit it for Aksel, drop some questions, follow Aksel on Twitter as well, because not doing so is actually cost you a lot of money, right? We are talking about the cost in terms of investing, of course, the financial risks. At the same time, we do not really appreciate at times the opportunity costs. The opportunity cost of not following Aksel Kibar is so much bigger than hitting the follow button. So I highly encourage everybody to actually just follow through on that. And without further ado, I think, or actually, before we dive in straight to the presentation, one question, actually, if you don't mind.
Yeah.
How's been 2024 treating you so far?
2024 has been good. Lots of excitement in different asset classes. Lots of volatility in commodities, and can't complain. It's been okay, and we're ready for the next year as well. So
Oh yeah,
let's roll.
Post-election year, 100%. And for everybody, again, Aksel Kibar is a CMT, highly distinguished charter market technician that I have a lot of admiration, and the presentation he always brings is of top quality. So without further ado, Aksel Kibar, the stage is yours. Please follow along.
Thanks, Adrian. Now I'm gonna put up the presentation here. All right. Okay. So It's clear, I guess.
Yeah, it's clear. We can also, up to you, we can also just highlight the entire presentation like in presentation mode. Right now we see all the slides as well. Up to you.
Uh, let's see. You can see. All right. Uh, so if I do this,
Can be this way as can be this way as well.
yeah. All right. So now it's the full screen, I guess, right?
It's just the way it was, although we can play along with this one, don't worry.
Okay, no problem. All right. So people who are familiar with my work know that I'm basically working on global equity markets, um, and looking at the markets from a classical charting perspective. So I've taken this step to try to simplify the world of classical charting. And over the past 7 years, I've been running the Tech Charts membership service, where with the members we're identifying classical chart patterns and keeping track of their statistics. And of course, many of them are actionable ideas, tradable ideas. And over time, we have started to come to some conclusions with the pattern reliability numbers. So I'm going to talk a little bit about those, and then maybe some eye-opening conversation following in the following slides, which I want to challenge some of the ideas that are built in into the technical analysis community, which can be costly. So I want to challenge those ideas a little bit and see how everybody feels about that. So let's start with the chart pattern reliability numbers. This is now a 7 year data, um, and the table at the top. So what I have done is basically, if you go and open a classical chart pattern book, you will see uh, several classical chart patterns, maybe 10, 15 sometimes. If you look at some other names, encyclopedia of classical chart patterns, you will see maybe 20, 25 different names given to those. What I believe and understood over the years is that those numbers are derivatives of select few classical chart patterns, which I decided that if I go back to those simple, old school classical chart patterns, that will be enough. And even human brain cannot identify more than select few chart patterns on price charts. So it's important that we select few and expand our universe across different instruments, different geographies, and try to familiarize ourselves with that sweet spot setup that we're looking for. So by doing that, I took 8 classical chart patterns, and over the past seven, now it's going to be 8 years. Over the past 7 years, I have compiled the data on these breakout opportunities that were featured on the weekly reports. So you can see that 2017, November 2024, rectangle is the top classical chart pattern in terms of success rate. Not only that, in terms of occurrence as well. So we don't want something that is 70%, 80% successful, but have 10 or 15 occurrences over several years. We want something that is reasonable to trade with in terms of number of occurrence and also success rate. So rectangle clearly is a winner over the past 7 years in terms of that. Now,
If I may, real quick, Axel,
yeah,
there is it's still showing the main kind of like a slide. Oh, there you go. Now we see it very well.
now you can see this.
Yeah, and even if you try to right click, maybe there's a way to just make a full screen out of that, or the bottom right, kind of like a icon, the bottom right panel and the icon close to the zoom in zoom out option, bottom right. There's like this presentation mode. So if you click on it exactly on the left side of it, there's like a presentation site exactly. So if you try to click on it, does it work?
Did it work?
it yeah, it's not okay. That's more than better right now. So I
Strange
appreciate it.
that it's not
That's all right.
able.
That's all right. Now we can see all the tables and everything. So feel free, go along. I'm sorry, go ahead.
Okay,
Go ahead.
okay. So you can see this table now clearly.
Yes, sir.
Okay. So I will just assume that we're seeing this presentation. Okay, perfect. Now I'm able to see that as well, follow up from the screen. Right. So now what we are seeing here is that the rectangle is being the top performing, followed by head and shoulder continuation. Now there is something that I want to draw your attention to. Obviously, people that are following me know that I've been banging on the table for so long about this head and shoulder continuation. There is a wrong knowledge that's going on. I don't know from which books people have read, but head and shoulder pattern can only form as a reversal. It can only form as a top or as a bottom. No, that is wrong. Head and shoulder can form as a continuation chart pattern. In fact, over the 7 years, the number of occurrences plus the success rate has pushed the head and shoulder continuation pattern to the second position in terms of chart pattern reliability. So we're talking about a 62.3% success rate and 138 occurrences over the past 7 years. So that's a good number, I believe. Followed by ascending triangle, cup with handle, symmetrical triangle. But what I'm going to do today is I'm going to focus on these two, rectangle and head and shoulder continuation, and we're going to start looking at something more interesting here. Now, if you look at the 2024 year-to-date numbers, which is the table at the lower part, you will see that again during this year, this time rectangle occurring 83 times, and then head and shoulder continuation 13 times. Again, they are at the top. Now look at symmetrical triangle. Success rate is 71.4, but it's not very meaningful because we only had 7 occurrences. Now, also bear in mind that this is not a systematic trading or systematic pattern recognition. It is a human that's doing this. So it's pretty subjective here. So subjective in what I would like to see. So over time, maybe I started leaning more and more towards picking those horizontal patterns and more rectangles. As the success rate improved, I started leaning more towards finding, or my eyes started picking up those patterns rather than a symmetrical triangle. So that's why maybe the rectangle number is much higher than the others. So you have 7 symmetrical triangles with a success rate of 71.4. But if you go over 7-year history, symmetrical triangle is at 55.3%. So both year to date and 7-year numbers is making head and shoulder continuation and a rectangle one of the better performing classical chart patterns. Now, what I have done is this, another step that I have taken, because people are always asking, what about the stop loss? What about the profit taking target? This and that. Uh, it's it's a very wide range of information and tactics. So one size doesn't fit all. What fits all is the pattern identification. Okay, but then comes the trading tactics. So where do you place your stop loss? I place it here, you place it there, below the pattern boundary for sure with the breakout. But how far from the pattern boundary? Where do you exit? Do you exit in tranches and so on? So what I have done is I tried to fit as much as possible to a one size fit all model. So I categorized each breakout. So I said, if a breakout breaks out, okay, and rallies to the price target without any pullback, it is as in this slide. Let me make it a little bit smaller so we can see it. Yeah. So if a breakout takes place and rallies to the price target, then I say this is a type 1 breakout. Okay. If a breakout breaks out and then pulls back to the pattern boundary without challenging the boundary, without dipping below the boundary, and then rallies to the price target, this is called type 2 breakout. So after the fact, I say, okay, this needs to be categorized as type 2. If a pattern breaks out, pulls back, but then it has a hard retest. So it breaches the pattern boundary, which means any tight stop loss that is placed below the pattern boundary will get triggered. Now, if you put a wider stop loss, it will not get triggered. But to maximize the reward to risk, if you're playing it with very tight stops, these are the ones that will get you out. So these are the ones that will basically, you shouldn't count them as part of your success rate, which I will come now to back to the table. And then there is the fourth type of breakout, which is breaks out and then immediately fails and falls below the pattern boundary. These are called type 4 breakouts. It doesn't even recover back above the pattern boundary like the type 3. Type 3 recovers above the pattern boundary and offers a re-entry condition by closing above that breakout confirmation level. And that is why it is considered type 3 breakout. Now, having reviewed those, we go back to our stats. And what you see here is something really interesting. Let's focus on year-to-date numbers. You see that rectangle type 1 breakouts are at 32.5% of all the breakouts. Added to that, if you put the 24%, which is type 2, you're reaching to 56% success rate rather than the 67.5. So 56% success rate when managed with aggressive risk management, tight stop losses, and reward to risks that are exceeding 3 or 4 in the considering the chart pattern price targets, you have an edge here. Now, more interesting is you see that if you act on the type 1 breakouts, usually those type 1 breakouts, which means the price is not pulling back to the pattern boundary and rallying to the price target, those exceed the price objective. So initially what you measured as, let's say 1 to 4 risk reward given the pattern price objective, when you realize that you're riding a type 1 breakout, by trailing it with an ATR trailing, you can easily exceed that price target and go to a little bit higher than initially measured. So 1 to 5, 1 to 6, which basically adds to the bottom line. And you can see that if you wait for a pullback to buy the stock with rectangle breakouts, you're missing 32.5% of the breakouts this year alone. Over 7 years, that is again 30.9. So when you see a rectangle, you have to immediately think that this thing breaks out and rallies, so I shouldn't miss this. Okay? Now let's look at head and shoulder continuation. What happens with the head and shoulder continuation is the reverse. Now you see that type 2 breakouts, which are the ones that pull back to the pattern boundary but doesn't fall below it, are around 46.2% this year versus type 1 of 7.7. So you're better off waiting for a slight pullback towards the pattern boundary to improve your reward to risk with the head and shoulder continuation. And if you look at the 7-year numbers, again, it's the same thing. While for rectangle, it is reverse, type 2 is much lower than type 1. Head and shoulder continuation is the opposite. Type 2 is higher than type 1. So when you're dealing with a head and shoulder continuation, you can use this knowledge that it might be better, obviously over the long run, that if I'm going to take those head and shoulder continuations, I can apply, wait for a slight pullback tactic, and then enter with a better reward to risk. So these are the numbers that we have, we can slightly use in favor of our in while we're doing making trading decisions. Which breakouts should you wait for a pullback? So we are almost answering that question here. And now I'm going to give you some examples from the recent breakout alerts that we had. And look, rectangles, um, this is something that we're discussing with the followers, with the members, and they're saying, hey, this is Darva's box. It is Darva's box, yes. And Darvas, when he was alive and he studied charting in his 20s, he was basically reading, probably, I'm saying because that was the material that was written before he was even born. He was reading Richard Schabacher's books on classical charting principles. And he probably took the rectangle at that time without even looking at the stats, and he made it his own, and he found success. Now, with rectangles, I'm looking at something interesting here. It takes two lines to draw the pattern boundary. So once you have, let me see if I'm pointing it properly. Yeah. Once you have those, once you have those two tops, you can draw a line there. And then what happens is that the third test is an opportunity for trading. What kind of trading? We know that it is resistance. So selling it and then trying to buying it low is an option. Now, once you have, as I said, two lines, this low and this low, you know that the third test, either it's going to break it down or rebound. You know that it's a support now there, and it gives you an opportunity to trade until the breakout takes place. And following that breakout, this thing turns into a trend following strategy. So you can use the signal from a range, breakout signal, and use it for a trend following signal, and use an ATR trailing to try to capture the trend period. So as you can see, it's not voodoo, it's not tea leaves reading, it's not the old school classical charting. No, this is basically trying to find well-defined consolidations and act on the imbalance that takes place between supply and demand. And those boundaries are very powerful in terms of that balance shift to take place. Another breakout alert. This is waist connection from Toronto Stock Exchange. It's a weekly scale price chart, and it shows a 15-month long rectangle. So once you have these two tops, you extend it to the right, you find that third top, and then once that boundary is cleared, you act on the breakout, and then what follows is the trend period that you would like to capture. So 15-month long consolidation is over. So you expect not a small trend period to follow, given the consolidation. We're going to come to BTC chart, and we're going to discuss about that. But I want to basically nail down this idea of long consolidations trigger strong trend periods in the direction of the breakout. Failures do happen, yes, but in almost everything there will be a failed breakout or a failed signal. It's about how to manage it in terms of the risk after that. Let's look at another one. This is a company from Turkey. Istanbul Stock Exchange, 1, 2, 3 tests, 4th test, and then the breakout. The strength of the breakout also is an indication of what to follow. What kind of price action will follow after that. So this was a strong breakout followed by a strong steady uptrend. Rectangle. Another rectangle here, Siemens Energy from Germany. So you can see the same pattern again and again forming in steady uptrends. So the beauty of those patterns are this. So when you see this consolidation in a steady trend period, it's a pause. It's usually discussed as indecision period between buyers and sellers, but I see it as an accumulation phase for the next move. And and because the initial move has started, this part of the move, this part of the move cannot take place without actual buying. So be it funds, be it ETFs, people have accumulated this. So the shares have reduced in the market. And then this consolidation, some profit taking. And the second part, it's much easier because there is less shares in the market. So you're basically betting when you read trend is your friend, this is the exact application of it. This is trend is your friend strategy. Going in the direction of the overall trend. Now let's look at some of the head and shoulder continuations, and you will see that these, how they're pulling back to the pattern boundary. These are the examples, some of the examples that I have picked up. So for a head and shoulder continuation to form, we need a prior trend. Okay, so initial trend is up, and then left shoulder, head, right shoulder. It's exactly like a head and shoulder bottom with a horizontal boundary. Breakout takes place. Price cannot reach the pattern objective, pulls back, and then rallies. So this pullback for the patient ones gives an opportunity to enter. So given that you see this head and shoulder continuation and you know the numbers that more often you get a pullback, you can easily wait for this pullback to take place. Next head and shoulder continuation example is CAR GLP from New York Stock Exchange. This is a 24-month long cockpit handle, and the handle part formed as a head and shoulder continuation. So this head and shoulder continuation breaks out, doesn't rally to the price target, and pulls back. And when it is pulling back, that is how it's falling under type 2 breakout and giving an opportunity for entry after the breakout takes place. And another example is Oracle, left shoulder, head, right shoulder breakout with a gap opening on the daily scale. And then we pull back. After the pullback, stock rallies and exceeds the price objective. So these are the numbers. It's not carved in stone. It can change over time depending on the market environment and so on. But I would take the 7-year numbers as a guide, and as I said, maybe it's becoming a little bit subjective with the way that I have been focusing on different chart patterns. Maybe I started looking more on the rectangles, but for now it is working. So why not taking advantage of those horizontal setups? Having said that, our next one is going to be about why focus on horizontals and avoid diagonals. Now, this is an important one because I started studying technical analysis back in 2000. So this is now, it's going to be the 25th year, probably, except my period in the military service. Every single day I got involved with charts and looked at charts, and some days, hours and hours. Probably I've been through millions of charts. And when I started, and I see it with many beginners, is that they like to draw trend lines. Trend lines with an angle. That's the first thing that we learn, to connect two lows and extend it to the right. And when you do that, you should be ready for adjustments. Okay? You adjust it once, you adjust it twice. The third time you need to adjust, somebody makes fun of you and says, hey, how many times you're gonna fail with this breakdown or breakout? And then you start questioning your methodology. Okay. So, and then people drop out, look at other methods, other strategies, and so on. So, what I would suggest, it's going to save you 2 3 years of back and forth, and maybe even keep on going on with your learning experience, is from the beginning, start with horizontals. Okay. So, when you look at horizontal patterns, horizontal boundaries, you're going to have much less signals, but quality signals. Why much less is bothering people? Because people want to be involved in the markets, constantly having another signal, because they have expectations of 100%, 200%, 300% returns per year. You will end up owning the world if that's the case. That type of returns we're talking about, accumulated over time. So lower your expectations, focus on quality setups, and try to stay in business as long as possible with those type of signals. This is a, a, a page from Richard Schabacher's book Technical Analysis and Stock Market Profits. Now, if your chart looks like this, you should immediately go back to the drawing board and start simplifying things. This is what I'm talking about. When you have the chance, you can draw as many lines as possible on a price chart. Some are meaningful, some have no value at all, and the steepness of these boundaries will change. Some steep, some less steep, and so on. Eventually, you will land on one diagonal line that would work. But the question is how many trials you would have in a trading situation to constantly revise your boundaries. Let me run this quickly. So we have, this is one of the most famous diagonal pattern. You have a breakdown here. And then following that breakdown, you realize that price keeps on going up. And what you do is you adjust your boundary. You try to draw another trend line, hoping that this time this breakdown will succeed, and then that breakdown also fails. Now, a problem with the diagonals is that, let's go back. So if this breakdown takes place, your protective stop should be above the pattern boundary, okay? So even if you place a tight stop here, this pullback, while it still looks like a pullback, penetrates into the pattern. And that's a dilemma. So should you get stopped here or not? Whereas with horizontals, you don't have that. If it starts dipping below the pattern boundary, you know that there's a pattern boundary there. But this is a moving line. So the breakdown took place, boom, recovery back above it. So let's go back to the place that we should actually take the signal. The signal is here in this rectangle. So you have a horizontal setup here. Breakout takes place, pulls back, and then the trend just keeps going up. Instead of looking for that diagonal boundary, even drawing something here to find the breakdown, no, you have one clean signal here, and it's that rectangle. 2 touch points, and the third one is a breakout, pullback, and continuation of that trend. Now let's come to the most exciting chart. What do we have here? This is Bitcoin, BTC US dollar. Let me see if everybody is clearly seeing what I'm seeing. Let me shrink it a little bit more. I think this is gonna be okay now. All right, we can see the time scale as well.
It's perfect.
Okay, so what do we have here? This is from 2012 all the way to 2024 monthly scale price chart. Now, one thing that is common knowledge, and I believe that this is totally wrong, is that technical analysis and charting is for trading purposes. It's only good for trading. It's only good for short term. No, it is good for asset allocation. It is good for portfolio construction, long term decision making. And as you can see on this long term chart, it shows clearly the long term trends, the long term consolidation periods where you wouldn't want to expect so much from it, and the periods that you would want to be involved in it. The time the breakout took place above previous highs, I want you to focus on the size of that monthly breakout signal. So I went back and I checked these monthly signals, these monthly candles are 35% moves from the low of that month. Similar breakout here on a monthly scale, that long white candle that closes at the top of that candle, which becomes the signal on a monthly scale, is again 35%. Here, this symmetrical triangle, which broke with that long white candle, again with a 35% move. One, two of those are horizontal breakouts. The third one is a diagonal breakout. But you can also see this monthly breakout here, breaking out above 20K with a long monthly candle. Okay. Now I draw my horizontal line at 73.7K. Okay. And you can see this tight consolidation right below the pattern boundary. And this is November's candle. Those who follow me would remember that I said October closed at the high of the, right at the boundary. And this short, tight consolidation is super bullish because the price didn't want to retrace back from the pattern boundary. And if we get a long November monthly candle, it will be another long-term signal looking to our previous signals. I'm not coming up with something here. I'm just looking at past price action, and I'm just trying to understand what the market is trying to tell us. That long white monthly candle is starting something after 2 years. So 2 years of consolidation here, and the pattern is being asked. What kind of pattern is this? What is the pattern? I am seeing it as a cup with handle. So this is the cup, this is the handle. Some analyzed it as a head and shoulder continuation, which this left being the left shoulder. Still, it's going to give us the same price objective. Remember that with upward breaks, we're taking absolute price difference as a measurement. So we're taking the depth of the pattern from the low of the cup to the neckline and adding it to the breakout point, and that gives us 137,000. Well, Axel, we're 37,000 away from the price target. Isn't this conservative? It is conservative, but it's the chart pattern price target. I cannot come and tell you price target is 1 million. So your job is at this point to ride it with a trend following system, but this is a monthly signal. That's what I'm reading from the chart. That's what I can say. There has been a lot of discussion yesterday and the day before, I guess, about 100K, 100,000 being a psychological level. So I've traded psychological levels in the past where it meant something from a technical perspective, and levels that didn't mean much and they were broken easily, and people thought that that's a psychological level. So at 100K, there is no resistance. There's no technical resistance at 100K, I said. So from a charting perspective, it doesn't mean anything. If some people are thinking that every round number can be a psychological level, so be it. But how do you formulate a trading around it? I cannot. I don't know. For me, formulation of a trading signal is a breakout above all-time high here at 73.7K. And I get more information from the chart as the chart moves. So as we were consolidating right below that pattern boundary, I remembered that price action from previous breakouts, because when you're sticking to a resistance and not backing off from that, it shows the willingness of the buyers. So that breakout took place. Now we're waiting maybe another 5 days, and then we will see what level the monthly candle closes. Uh, for those who would say, well, this is a late signal, fine. As I said, this is a long-term signal for asset allocation purposes. If you look at the Edwards and McGee, uh, the broadening pattern that has been discussed, that broadening pattern, here I highlighted, this is a daily scale chart. The horizontal boundary and the lower boundary is expanding. Same chart here, another stock that Edwards and McGee featured, the horizontal boundary. So let's go and see what that cup with handle on the monthly scale looked like on the handle. So that was the breakout on the weekly. So that's your weekly signal. You see, this is the cup, and the handle formed as a broadening pattern with a horizontal boundary, in my view. A lot of people drew this downward sloping and acted a little bit earlier, but for me it was a horizontal boundary, and the fact that market proved the horizontal boundary with that weekly candle of the long upper shadow. So market experienced the resistance there. Otherwise, if there was no resistance, it would have just started its move from there. But first, we've experienced that resistance. So that's broadening pattern was your weekly scale breakout signal. Now, when we go to the monthly, if November closes strong, it will basically tell us that many months to come, trend is going to be upwards as long as we are remaining above that 73.7 pattern boundary.
Such a clean example. And by the way, for everybody, this is a kind reminder that within this session with Axel Kibar, CMT, you're gonna have a chance to drop one or two questions. And before we wrap the session in about 3-4 minutes, we're gonna have just a moment to answer one or two of those questions. So if you have any questions featured, then get them ready. Keep them coming in the chat. And back to you, Axel. Within the next 3-4 minutes, we're gonna take one or two questions, right? And then we're gonna
Yeah,
wrap the session. The beautiful chart so far.
Adrian, let me quickly finalize the following slides because some of the ideas are there. This is ETH versus BTC chart. Again, you can see two signals here. One is the head and shoulder reversal, bottom reversal with the horizontal neckline. And the second one is this rectangle, which broke down at 0.05, which led the move like this. Now you can draw this diagonal boundary, but which one do you depend on if you ask me? I have depended on the horizontal breakdown. Fine. Next is a BNB US dollar chart. You can see multi-month long horizontal boundary. Now we have already completed the third test. It's just a breakout is needed. Prior to that, breakout from 355 started with again a horizontal setup. And you can see this, you see this short consolidation right below that pattern boundary. It's like the BTC US dollar chart, that consolidation on the monthly scale. So price not willing to back off from a resistance is usually an early indication of a breakout. Let's go to the next chart, Algo US dollar, a possible rectangle reversal here with now 3 tests already completed. A breakout would possibly target 0.5 and above. And then meme coin or altcoin, I'm looking at the charts. I'm trying to give you guys a perspective here to focus on the type of setup. This is Floki USD chart, and you can see the perfect rectangle that's forming. Earlier breakout was with a cup with handle here, again a horizontal pattern. So you go and find those clean horizontal boundaries and act at the time of the breakout. The other chart, again a perfect textbook rectangle, is PVEX US dollar chart with both targets on the upside and on the downside depending on the side of the breakout. So this finalizes our presentation. I hope you guys got some ideas in terms of that will speed your charting experience and the way you look at these markets from when you're taking one chart at a time.
Very well. That's very well thought through, Axel. And that this is the time for actually to quickly run through one question. There's an incredible question regarding the time frames, right? What are the time frames of strategy? Everything that is showed so far has been tested on us in the monthly, weekly, daily. Does it work and apply to all the time frames equally, or are you having any particular preference before we end the show?
So the time frame is daily and weekly, definitely not intraday. Okay, I have never taken any intraday breakout signal. Even for managing trades, I like to go with the daily breakouts. So monthly is too long and it is difficult to manage for many in terms of trading positions. From an asset allocation perspective, yes, as you can see on the Bitcoin or gold chart that I'm sharing, monthly is good to use to get the big picture where you're standing in terms of the trend. But all the stats are weekly and daily scale price charts.
Love it. And above that, even intraday tends to become very very noisy.
It
Ladies and
is.
gentlemen, what an incredible feast of all the technical class patterns recognition, you know, proper feed all the technical people, everybody who's is amazing. He himself, chart and market technician, like I said, classical chart trader, ex fund manager as well, privately my good friend and true person that I always look up to, incredible artist in the technical world. Aksel Kibar has been our guest. Thank you so much for your time and generosity with the wealth of knowledge, Axel.
Thanks, Adrian. Thank you, everyone, for joining. I hope you enjoyed it. Have a great day.
Yes, please. And please go ahead and give a follow button to Tech Charts at handle Tech Charts on X. Definitely, you're not going to regret it. And everybody, this is my true pleasure. Thank you so much for spending time with us. And the session goes on. Trading Congress 2024 goes on. We've just kicked off, and so many incredible guests are coming in. Aksel Kibar has been the highlight for now so far. Thank you so much, everybody. I've been your host, Adrian Zenchuk CMT. God bless you all and see you on the next shows.